Money Morning Live. It's time that we hang out with Tom Gentile. We do this during Power Profit Trades. You never know what you're going to get when you have Tom in the room. Discounts could be flying around, good times for sure, and learning how to make money. Let's bring in Tom in 5, 4, 3, 2.
Hey guys, Tom back again. Welcome to Power Profits Trades, right straight up 12 o'clock. We've been talking the last couple days about volatility trades. We talked about calls, puts. Today, we're going to get into straddles. Before I do, because we don't have a whole lot of time to discuss all the things I want to cover with you, let's talk about Brutus for a moment, and let's go back to Monday, where we had 5 potential Brutus trades that popped up. I called it our first pass. Eric, if you could put the first pass back up there again, that'll be great. These 5 trades, what do they all have in common? Well, they all have patterns of moving in one direction or another up into earnings. Some of these have bullish patterns. Some of these have bearish patterns, right? So we had Futu, Umbrella, OKTA, Hewlett-Packard, and Oracle. Yesterday, we did a second pass. That means Brutus takes those 5 stocks, reanalyzes them again, goes out and looks for sweet spots in terms of what's the best time to get in and the best time to get out. And Brutus did exactly that. And of course, we now ended up with a second pass, which took us down to just 2 stocks and 3 potential trades. Now, today, I'm going to talk about not just Oracle and Hewlett-Packard and find out which is the best, but I want to reveal straddles. I want to talk about straddles. I want to talk about what Brutus is showing us. And I want to talk about how you can join me in this strategy that we do day after day, week after week. And it's been crushing it for 2022. Eric, remind the folks out there how well they'd be doing right now following this type of volatility strategy using Operation Surge Strike.
I think that's a great idea, Tom, because right here, if you're following the 83 open and close recommendations, $2,000 into each trade roughly brought you $29,000 in profit. $5,000 into each trade roughly brought you $73,000 in profit. 46 triple and double-digit winners year to date, 6 for 7 so far, just right now, Tom, in August.
Hey, let me tell you something. Each of those will do more than cancel $10,000 in student debt, which is what I saw coming across the wires today. I mean, following a rules-based trading strategy, you don't have to worry about that kind of stuff. All right, we only got a half an hour, so let's go ahead and get started. Eric, yesterday or Monday, I started off showing everyone how to create a stock list, how we take that list of 4,000 optionables down to just a few hundred that we can use for strategies such as this. We also talked about what a call option is, and I showed everybody how Brutus goes through and takes those 4,000 stocks and does that first pass. Then, yesterday, we did a little call review, we did a little Brutus review, and we talked about put options. We also took our list and we did the second pass, telling some of those stocks in the first pass, thank you very much. Come back again next quarter. Let's see if you make the second pass then, right? So today, what I want to do is I want to talk about straddles. I want to go through Brutus once again, and I have much, much more to show everybody. So let's go ahead and let's talk about straddles. Now, for those of you in the room, let's poll the room. How many of you in the room have never taken a straddle position? You don't even know what a straddle is. You think you know what a straddle is outside of the markets, but what are we talking about when we talk about a straddle, right? I want to talk about the positives. We'll talk about what a straddle is. I want to talk about the positives and the negatives of straddle trading. So first, what is a straddle? Well, by definition, a straddle, and I have it on the screen right now, is the simultaneous purchase of a call and a put, all right, with the same strike price and the same expiration date. And most of the time, if I'm purchasing a straddle, then I'm doing what's called an at-the-money straddle. That means I'm using a call and a put that is as close to the stock price as possible. So if a stock is trading at 101, then I might use the 100 straddle, the 100 call, the 100 put. I'm going to use the same expiration date for each. This is a one-ticket trade. That means you can place it all as one trade, and your broker should be able to offer you that as a choice. Now, if your option broker doesn't allow you to trade straddles, change brokers. There are several out there that allow you to do that and much, much more. Now, the buyer of a straddle, which is what we are in this particular case, the buyer of the straddle has the right, but not the obligation, to buy or sell said security at the strike price on or before expiration. Now, how do you have the right to buy and sell at the same time? Well, it's very simple. You, as a buyer of the call side of the straddle, you have the right to buy the stock on or before expiration date. As the buyer of the put side of the straddle, you have the right to sell that security on or before expiration. So a straddle trader has both rights on the buy side and the sell side. Now, if you're looking at being a buyer of a straddle, you only have those rights up to expiration. If you go through expiration on a straddle, whichever side is in the money, that will automatically exercise in your favor, right? In your favor is if the calls are in the money, you could get exercised long stock, or short, or if the puts are in the money, you could get exercised short stock. The only way that a straddle doesn't auto exercise past expiration is if it closes directly at the money. So for instance, if I have the 100 straddle and you go all the way to expiration and that stock closes at 100 on the dime, all right at 100 on Friday expiration, then guess what? Your option, you're not going to get exercised on either side. We don't want to do that though, folks. I'm giving you the specifics of what a straddle is. Now, for that right, all right, for the rights and no obligations, you, the buyer, pay a premium. You're paying for both the call side and the put side. So a straddle, in essence, is one of, if not the most expensive options purchase. Straddles are often called delta neutral trades because you don't have directional risk. You have what's called non-directional risk, and the trade is non-directional in nature. Now, let me show you an example of a straddle using the same example we were talking about this week, and that is John Deere. Now, Monday, we talked about the John Deere calls. Tuesday, we talked about the John Deere puts. Today, I want to talk about combining both the trades. So a straddle would be buying that call option and that put option, and this is the at the monies, folks. All right, we were looking at on the 18th. If you were looking at John Deere and said, boy, tractor sales or either they're going to be really up or they're going to be really down, and this stock is going to blow one way or another, I'm going to take a non-directional trade because I thought buying a straddle, I can make money regardless of market direction. You can, but this is one of the worst ways to do it, and I want you to put this in your brain and say, I will not do this. I will not buy an at-the-money call and put right before earnings and go through earnings, right? Because every once in a while, you'll be right, but most of the time, statistically, this is a losing trade, right? And we want to show you how to do it right. But in order to show you how to do it right, Eric, I got to show everybody how to do it wrong. The wrong way is we buy this right before earnings and we hold it through earnings. Now, this call and put, the call costs $9.45, the put costs $7.75. The straddle is when you add both of these together. This trade is going to cost $17.20. Multiply that times 100 because that's the contract. When you buy a call and a put, you're basically buying. You have that right for 100 shares of stock. You take the $17.20, multiply times 100, and your entry debit is going to be $1,720. Okay, $1,720. Now, you have an unlimited profit potential because we don't know where it could go, especially to the upside. It could be limited to the downside if the stock goes to zero, but I don't think John Deere is going to go to zero in one day, but it could go up or down quite a bit. This is why a lot of people like to trade these. Meme traders love to trade, love to buy options right before earnings because they're looking for a big jump one way or another. Let me tell you, that's what caused meme traders to lose their stimulus checks by betting on these, by speculating these big moves. In most cases, they never occur. So $1,720. This is what the risk graph looks like when you trade a straddle. Now, what I did is I colorized this. So here's the stock price coming down, coming up. And if you're buying the straddle, you're buying that at the money call and at the money put. Well, if the stock goes up, you could go into the green side and you could get a reward on the straddle, because the call will make, if you're up here, the call will make more money than the put will lose. Now, if John Deere fell apart and we dropped down real hard, the put option could make more money than the call loses. Where the risk is if in the middle, if it doesn't move anywhere. Well, here's John Deere. We all know what happened to it when it came through earnings. It pretty much settled not very far from where it was the day before. And you know what happened to the straddle? The straddle dropped 84%. What ended up happening? The 367.5 calls, which were 945, well, they went for $1.40 by $4. The puts, the 775 puts, well, they were 1 penny by 9 penny. You could see where all the money was lost. It was lost on both sides. Now, yesterday, Eric, I was talking about Intuit, and I said, watch Intuit. Let's see what happens to it. Well, this was Intuit not long ago. I took this snapshot. This was the close of yesterday. Intuit jumped up. It was up over 20 points. It was up over 20 points about a half an hour ago. Now, you would think with a big jump like that if you bought the straddle on Intuit, that you would have made money. Think again. Here's the straddle on Intuit. If you would have bought it yesterday at the close, you would have paid $13.25 for the call, $13.65 for the put. You're talking about something just south of $2,700. Well, guess what? Even though the call option went up from $13.25 to $23 and change between the bid and the ask, look what happened to the put. It dropped down to 75 cents by $1. So while you made $1,000, see that? While you made $1,000 on the call, you lost $1,277 on the put. Again, wrong way to trade straddles. What we want to do is we want to take you out of the risk of straddles. Now, once again, what is the risk of trading a straddle? You have 3 risks. You have delta risk. You might say, well, wait a minute, Tom, you don't have price risk on this because it could go regardless of market direction. No, as an option buyer of a straddle, you lose if you have lack of price movement. All right, so little to no movement, you have price risk. Theta, because of that little to no movement, you have accelerated time risk. And the acceleration of the time risk comes from the drop in volatility. Again, if we look at Intuit for a moment, notice that even though the stock jumped in value, look at the option premiums. Look what they did. They collapsed from 57 down to below 38. So 57 to 37, that's a huge drop in time premium. It's a huge drop in volatility. And so that's why this straddle, this Intuit trade, if anyone took Intuit and said, I don't know where it's going, but I'm going to buy the call and the put. Well, doesn't work. And the reason it doesn't work is because you're trading the wrong side of volatility. The right side of volatility is to trade the surge before earnings. All right. So we talked about it Monday. We talked about if you're going to buy call options into an earnings report, it's better to find a pattern of stocks that go up slightly into that earnings report and the volatility goes up rapidly. And you get in and you get out before everybody knows the answer. The answer is what? What did the earnings result come out to be? We want to be selling that ticket off to somebody who's dumb enough to buy it. There, I said it. And so you can see the pattern we're looking at here, folks. This is not a price pattern. This is a volatility pattern. These are at the money implied volatilities. This is the angst, if you want to call it. As we get closer and closer to earnings, what's it going to be? What's it going to be? I want to buy calls. I want to buy puts. I want to buy straddles. And that pushes that surge. And that actually changes the course of not only volatility, but it changes the course of theta. It changes the course of option premiums, time value. Time value in some cases actually reverses itself as you get closer to earnings. And then it comes screaming right back after earnings because the unknown is finally known. So we see that. And I'm showing you what we're looking for is patterns where this happens over and over and over and over again. Is it guaranteed to happen in the future? No, there's no guarantee in trading. All right. Guarantee is eventually going to lose. You're going to lose here or there on a trade. But the thing is that by creating a rules-based trading system, you're looking for consistency. All right. Consistency. So what does consistency look like on straddles when you follow a surge strike? And a surge strike is getting in before and getting out after. These are the straddles that we've taken in August, right? From the beginning of August until just early this week. So you see here, we had a Disney straddle. This is the call and this is the put. And what you're seeing here is, check this out. The Disney straddle, how did it do? Well, in on 7/19, out on 8/11, 179% return. Look at the CPNG straddle. So that's an 18 call and an 18 put. By the way, that straddle you could do for about $2.30. So if you think straddles are expensive, well, you're picking the wrong ones. This is a straddle where the cost of the call and put combined were $2.30. It went up to $2.83. Not much, but that's a 23% return on something that you were going into earnings and the stock didn't move much. What ended up happening? The straddle did really well. Look at the Rivian trade. We did Rivian puts earlier in the year. Well, Brutus looked at Rivian once again and said, the straddle makes more sense. And the Rivian trade, again, this was a 33 call and a 33 put. This was a trade that costed a little over $6, but ended up closing out. We closed it out at 7. So we made almost $1 there, right? 15, almost a 16% return. Here's BBWI. This is an example. Not every one of them work. Okay, 40 call, 40 put. This was put on for 453. It was taken off for 366. That was a 19% drop. And then finally, we had a TPR straddle that really just went, we got into it for 310. We got out of it at 330. But you can kind of see the idea we're looking at here. That is, how do we control risk? You control risk by controlling not only what you're getting in at, but making sure you get out when everybody else is piling into the trade. All right. So that's what straddles do for us, folks. Okay. I've shown you the wrong way to do it, and I've shown you the right way to do it. The wrong way to do it is, if you want to do it the wrong way, then I can't force you I can't force you to trade any other way than what you feel comfortable with. But the wrong way to do it is getting all excited, putting too much money into one trade, listening to the guy that has the biggest mouth on mainstream media or on social media, and then following them, where I offer you rules-based trading, years of back testing, thousands of stocks that we go through as we're looking for patterns. Pattern trading, in my mind, much better consistency. And then when you look at this list once again, you're going to see outside of Disney, I mean, it's like kind of like watching grass grow, 23%, 15%. There was a drop in 19. There was a small 6.5% move. But over time, we tend to see more winners than we do losers because we're following a volatility strategy. And this is pure. This is a pure volatility strategy when you trade straddles. All right. So, I think it might be time to get into the Brutus trade where we started out. Remember that? Let's put that list back up one more time, Eric. So you got once again, you've got the top 5, which became the top 3, Oracle and Hewlett Packard. So who's it going to be? Is it going to be Oracle or is it going to be Hewlett Packard? How many of you out there that did a little bit of homework looking at these two trades believe that Oracle has a better pattern than Hewlett Packard? And how many of you think Hewlett Packard has a better pattern than Oracle? And how many of you are saying, well, what's the pattern? Because I haven't shown you the pattern, but I'm going to show you the pattern for each right now. Let's start with Oracle. So Oracle, guess what, has a pattern of dropping into earnings. Dropping into earnings. You can see the last, I got them on the screen here. This is the last 2 patterns going into earnings, where we had the stock pattern going down and we had the volatility going up into earnings. Stock pattern going down, volatility going up. There's the surge. There's the surge in both cases, where we actually saw, forget about price for a moment, what it did in price drop. Look at this red line. This is more important. The red line shows us going from somewhere in the 30s all the way up to above 70. So what we saw coming in that 1 to 2 weeks prior to earnings is we saw a double in terms of options premium. So options premium, if you're purchasing it a week to 2 weeks out before earnings, it doubles the day before earnings. Okay. Now, that doesn't mean your trade's going to double. What it means is that we're seeing volatility, that implied volatility that surges up right before earnings. This is good for the option buyer, by the way. Now, Oracle has its scheduled report on the 12th of September. So that's a few weeks away. How about Hewlett Packard? What does it do? Now, Hewlett Packard has had a 75% historical bullish pattern into earnings. While Oracle's been bearish into earnings, Hewlett Packard has been bullish. You can see here, went up a little bit back in, I believe it was February, the February-March cycle. And then in the May cycle, it went up pretty good bit there right before the earnings. And in both cases, look at the volatility. Volatility went from 40 up to around 75 and then dropped back down to 40. And then this one, we were actually trading closer to 45, went up to 75, and then right back down below 40. Where's volatility right now? Volatility is starting to get on the climb again. This one's on the climb now. It's trading right around 50. So you got two trades here. One has a bearish pattern, that is Oracle. One has a bullish pattern, that is Hewlett Packard. There are probably some questions right now that people are asking. I have compiled a list of the questions that you should be asking after looking at these. All right. So again, the pattern on Oracle is going to top out right before its earnings announcement. All right. Not so much the price pattern, but the volatility pattern. And the volatility pattern in Hewlett Packard is going to top out at the end of August, the 30th, because that's when their scheduled release is. So here's some questions you might be asking. When and how do I enter these positions? Okay. Well, that is still yet to be determined. Okay. Because we're not at the sweet spot on either of these yet. What options should I use for my entry? Well, I can tell you that I would be looking at put options on Oracle. I would be looking at call options on Hewlett Packard. Typically, those options that are near the money work. What is the projected return on these options? Well, that's where we go and we do some back testing to find out what our projections are looking at. When do I exit the position? Well, you want to exit before the earnings report date. Okay, that's the termination. Can I put a limit order in ahead of time? Absolutely, you can. A lot of times what we do is we'll put the trade in based on those projected returns. We'll use that as a limit price to get out. All right. Or we get out right before the close prior to the earnings report. Now, what if things change during the trade? All right. And that is where I utilize Brutus, because Brutus comes through and will give us the answers to all those questions. The initiation point, that's when the surge starts. The termination point, that's when the surge ends. Okay. What we all know right now on Oracle and Hewlett Packard is we know the termination point. We know that is right before the earnings come out. But we don't know the initiation point because we haven't gotten to the point where Brutus is saying this is the day to put these on. Right? We can get ROI projections on both Oracle and Hewlett Packard. I can tell you right now, Oracle has a higher ROI projection somewhere in the triple digit area. Hewlett Packard is in the higher double digit area. So that makes Oracle a better projected return for the options. Oracle also has a better historical accuracy, as I showed you. Over the last year, Oracle's at 100%. The last year, Hewlett Packard is at 75%. And so this is how we answer those questions, and this is how we serve these trades up for our members. And we're talking about real trades and real returns. Eric, if you want to show the fine folks here what kind of real trades and real returns we've gotten, we've like I said, I was talking about the Ford trade, 100% Ford in 8 days. There's a BX trade that had 115% in 11 days. Uber, 126% in 4 days. We've had 100% on Autodesk in 7 days. At 179% in Disney on 22 days. You now know that was a straddle. All right, but all of these trades you see, all of these, I can tell you none of them we threw a dart at a wall and said, oh, I want to take this. No, every single one of these trades went through the Brutus first pass, the Brutus second pass, and got to the point where we then take a look at it. We get our eyeballs on it to make sure that the data is correct. And then it's a matter of putting that out to our members. And so That's exactly what we end up doing here. So both of with our real trades and our real returns, you can see here that all of these, and we have losers, but in both the winners, which we have many more of, and the losers, we follow our rules. What are our rules? Once again, if you're looking at Brutus, the Brutus questions and answers the questions, Brutus gives us the rules that gives us that initiation point. When is the right time to get in this trade before everybody starts talking about it? Termination point is when to get out, when everybody's talking about it, right? Surge magnitude, that's a volatility increase. That was what I was showing you right here. When we look at the red line, that volatility increase, with the example with Oracle, we were seeing doubles. We get doubles between when that surge was just getting started to the end, and we're just about to get started on this one again here within the next, I would say, with Oracle, it's going to happen here within the next week or so. So while I can't give you an actual trade here today, I'm giving you the stock, I'm giving you the direction, and I'm telling you, put options on Oracle, call options on Hewlett Packard, but to give you the actual when, to give you the actual target, to give you the actual exit, well, that requires Brutus in real time. So for us, what we're looking at here is, once again, if I could talk about Operation Surge Strike, and what we do is we have what I think is a fantastic offer for what we're doing, folks, with Brutus. What Brutus does is this: scans 4,000 optional stocks. We look at patterns that are no less than 75% to 100% accuracy. From those, we then optimize those patterns for the optimal trade entry and the optimal trade exit. Now, when we get those, once we've vetted them, we then send them out to our members, and we'll send those out via email. You also get text alert service with that. That comes with videos, the whole Surge Strike 101 tells you exactly what we're doing and why. We also talk about how to place the orders, how to place your exit orders. Again, we do exit strategies as well, but we will let you know when we get out of these trades if they deviate from our patterns. We have a really, really good offer going on right now, Eric. We call it the 93% offer. And so part of that with that 93% offer is not only do you get the trade recommendations that we do, and they don't always come out. Guys, what you're going to find out about Operation Surge Strike is I'm not looking to do 5, 10, 15, 20 trades in 12 days. I don't promise that, okay? What I do promise you is that we will give you the best trades over each earnings cycle, right? In some weeks, we might have only one. And in some weeks, we might have 3, 4, 5, depending on what we see happening through earnings. But what we end up getting is we get a couple dozen really good trades every single quarter. And so if you want to be part of Operation Surge Strike, come and join us for our 93% off. And this is the lowest price we've ever given out. For those of you who are brand new, you want to take a sneak peek under the hood, this is the time to do it. And plus, you're going to get live group coaching with me and my team. All right, we do that every single Tuesday at 1 o'clock. And so I look forward to seeing you, as well as Mike Wade. We look forward to seeing you in the room as an Operation Surge Strike member. Again, click on that link in the chat or contact Gabe today for our best ever price. Once again, guys, thanks for joining me this week for our options training camp. I hope you guys all learned something about calls, puts, and straddles, the wrong way and the right way to trade them, as well as how we do this on a consistent basis. So, Joe Conte is going to be here tomorrow. Otherwise, I will see you same time, same channel next Monday morning or right at noon on Monday when we will pick this all up once again. Until then, have a great rest of your day, and I'll see you soon. Bye, everyone.